Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You're here with Ben Brayshaw and Dan Michelon. How you doing, Dan?
Doing very well. Excited about today's show.
Yeah, me too. We're missing our partner Seth, as we had announced last week. He's going through some medical treatments. He is in recovery, and that's good. Things sound like they're moving forward well, and we're hopeful and we're in prayer. And ask all our listeners to continue praying for him. We miss having him here every week. He definitely keeps us laughing. But you dearly miss Seth. So Dan, you want to tell us a little bit about our show today?
Yeah, a lot of the news I've been reading about and coming across articles suggesting this lost decade notion, where we went through this from kind of the beginning of the 2000s through about 2009. We're
not talking about your college years, are we, Dan?
No, it was a little longer than a decade. That was, but it was lost, that's for sure. But we went through a period in the market where the S&P 500 was basically ended up in 2009 where it began in 1999. And that was a very difficult time for investors. And there's a lot of concern around, things that are common to what's happening in the market in the last 3 or 4 years as to what preceded that decade. But really what we're going to talk about today in the show is how that is something that you don't necessarily need to be overly fearful of. There are ways to invest that worked in those times and will work again, we believe, going forward. So if that's something that you've read or heard or seen any of these pundits talking about, rest assured, we're hearing those same things as well. But it is not a fate that is guaranteed to anybody.
I think this is a hot topic for a lot of things because there's been a few lost decades for various, investments. We were listening to a call the other day about the lost decade on commodities, and there are cyclical investment opportunities, and there are times when those investments just sit dormant or stagnant, and you're like, why didn't I ever think about getting into that, 2 weeks before it spiked? And, but people have been sitting there potentially for a long time. And we're going to talk a little bit about investing and waiting and being patient because as we get into our Money in the News, we're going to talk about some investors that have been very patient, and I'm excited about that. With that, we're going to go to Money in the News. First up, always my favorite topic, is the Democrats are proposing bills to send gas payments to Americans, funded by cards, of all things.
Yeah, more printed money in plastic form, right?
Plastic form that has nothing to do with cash, of course.
Right.
This is really very interesting. I mean, obviously, we are all paying a horrendous amount, 100% more than we were paying even a year ago at the gas station. And it is fearful. It's complicated. I was talking to a gentleman just last night. He's a teacher down in Massachusetts, lives up here in middle of New Hampshire. And he's driving, almost an hour and a half each way. And when he moved north to get a little bit more land, a little bit more of a place, a little farm kind of thing. He, said, I can drive. It was only $2 a gallon.
Thought a lower cost of living too, probably.
Exactly. And, because there's obviously a difference in pay rates between teachers in New Hampshire and Massachusetts. And now he's like, I'm not sure that there is a difference anymore just because of the cost of gas and the travel that he's enduring.
Yeah. I mean, obviously it's a problem and it's something that's impacting everybody. But some of the suggested fixes, I mean, it wasn't necessarily part of this article. It's not a federal program, but I saw the governor of California was proposing $800 a month in gas, relief to everybody driving there. When the idea of doing something at the government level, whether it's state or federal, to offset this issue, given that it's certainly nothing any of us deserve or have asked for, or result of our behaviors here, there's some insight there, and it makes sense, but the idea of just pumping straight out cash back into the economy again in light of all the inflation and supply issues we've run into just really seems like a bad idea.
I think the thing that's really, I don't know if everyone doesn't understand the economics around money movement, but if the government's going to tax you and then give you money back one other direction, it's like we just didn't need to do the tax to begin with. I mean,
Or we just created more taxes later.
Yeah, exactly. And then the other conversation of, I mean, we've known that, you know, the Biden administration and the Democrats have been at war with oil for a very long time because of a lot of the approach of the green energy, right? I mean, you can't make green energy affordable unless you make oil consumption expensive, you know, so there's that kind of reverse scenario here. I think it's funny that California's proposing that, and yet, I mean, they're the biggest proponents of green energy. I mean,
yeah, it's a little hypocrisy there. But, you know, one of the things, there are things that can work, and I believe here in New Hampshire, as an idea, they've temporarily halted the gas tax, which is 22 cents a gallon. Which is something that can be done at the federal level. About 25% of the overall cost of gas at the pump is federal taxes. So there's, you know, in my mind, rather than, again, handing out cash that you don't really know where it's going to be spent, and in light of the inflation we're facing, you know, a little bit of pressure relief on the gas tax makes a lot of sense, you know, done well here in New Hampshire. And if we really do want to cut costs at the pump in a significant way, you know, I hate to say it, but you know, I'd rather just pay the gas stations to lower the price than just pump cash into the economy.
Well, I mean, if you take the tax off, then you know the people who are actually consuming the gas are the ones getting the credit.
The money's actually going to the gas as opposed to, you know, his cash, and we all know how that's gone, right?
We all know that these gas cards are going to be, you know, traded, sold.
Yeah. You know, it's like the PP relief bought a bunch of Ferraris, you know, not really what we were looking for.
Well, yeah, you don't need somebody who lives in downtown New York City who's riding the subway getting a gas card. I mean, this doesn't make sense.
Yeah, but if there is a relief out there, and I'm hopeful for that, but put it right into the tank.
Yeah, exactly. Agreed. Totally agreed. Well, as I had mentioned earlier, we talked about being patient on investments. Wrong order. Sorry, Dan.
That's all right.
But, you know, but being patient on investments. And, you know, probably one of the most patient investors I think I can think of out there is Warren Buffett, Dan.
Yeah, I mean, he is not only one of the most patient, but the most prolific and well-known, and, you know, for lots of good reasons. You know, we talked last week about kind of following the Pelosi portfolio and all that, which, you know, she continues to make interesting buys, her and her husband. Saw a little bit more about that today. But, you know, if you're going to track an investor long-term, and following the behaviors and mimic their moves, can't do much better than Warren Buffett, I would say.
Yeah, no, I agreed. I think it's interesting because, you know, Buffett, you know, we've done a couple shows where we've actually talked about some of Buffett's like rules. And, you know, I remember one of his rules was don't lose money on an investment. And, you know, I think that rule comes into his level of patience that he's shown to a lot of investments. I mean, as we talk about some of the holdings he has, you know, Berkshire Hathaway, which is the company that, you know, all of his portfolio stuff falls under, Apple comprises 47% of it.
And has for a long time. You know, that's patience, right?
I mean, talk about an overexposure. I mean, that's not balanced. You know, that's tough. I mean, with about 1 billion shares of Apple and 157 billion or whatever it's worth today, probably $170 billion worth of assets, like that's an enormous position in one particular company. Now, granted, Apple's the largest company in the world, seems to be the most viable tech provider. It seems to be the most innovative until somebody comes up with something completely different.
Yeah, I mean, you think that, you know, especially in technology, it's an ever-changing field, and, you know, kind of the leader of any given product line comes and goes and changes over time, but there are truly a couple of horses that I think you can run with, and certainly Apple's one of them. Microsoft, you know, IBM's floundered a little bit, but they've got a track record that would suggest, you know, there might be some room for growth there down the road.
Yeah, I mean, just thinking about how Apple does fluctuate. I mean, it does have some kind of like hairpin turns in the market. I mean, they're talking about, you know, like what, over a week or so of continued rise in Apple's share price recently, but I mean, that was after like a 15% pullback. I mean,
you know, I was talking about something yesterday. It's a little off the topic, but this Apple bundle, have you heard anything about that?
No.
They're thinking about leasing hardware to people. You know, you can buy a bundle of, or lease a bundle of, you get your phone, your AirPods, laptops, whatever it is. So like you would lease a car or something to that effect. You'd be able to lease or rent Apple hardware.
Don't do it to my kids. I think Apple's going to lose on that one.
But anyway, kind of digging into the rest of the article, and it was around the top 5 holdings. So I thought that was interesting, just to see what the top end of his portfolio looks like. But it's comprised of Apple, which we dug into, Bank of America, American Express, Coca-Cola, and Kraft Heinz.
Yeah, and I think this is really interesting because talking about patience, he's owned Coca-Cola since the 80s.
Yeah.
I mean, that is a long time to hold a company. And I mean, I'm sure he's changed his positioning and so forth in it, but I thought it was really interesting was that Kraft Heinz, which was Kraft originally and then Heinz was a separate company, he's owned for quite a bit of time, but he owned it at a high of 96, and back in 2017, it was trading at less than $20. I mean, just that's a massive, that's a massive loss in a portfolio, and just to be sitting there and saying, hey, I didn't have a stop loss, I wasn't, what was the move on that to hold any portion of that in the volume he's holding is probably a pretty huge hit to the overall performance.
Yeah, I mean that's a testament to his notion of don't never sell at a loss or take a loss in an investment. There must have been something about that company he believed in, and he's been committed to that belief, whatever it is, and is willing to ride the tide.
Yeah, I agree, and I think there's a lot to be said about that patience. I mean, I really like when we deal with investments, I really like, I may not really like a company per se, like it may not be something I use, but if I see its viable offer, I really think it is let's say I was allergic to ketchup. I know ketchup's on every table out there, right? I mean, every diner, you name it. If I have a belief that it's a profitable, sound, financially good company, that's the premise that, Buffett invests with, which I think gives people the ability to have patience, where a lot of people managing their own money, unfortunately, they're just so unsure of what they bought to begin with that they run out of the market way too quick. Like the average investor would have probably dumped, Kraft at $20 a share and said, this thing's going to zero and I'll take my $20.
It takes a special type of person, honestly, to watch these losses, hitting a portfolio. But, the ability to hang in there is difficult. And not to suggest that's always the way. At some point, you might need to cut and run. But the patience there, that aspect of it, it can come back and be fruitful for you. But, that's where the professional advice of advisors comes in, and the understanding before you choose to invest what your tolerances are. It's very important to keep those things in mind.
Yeah, and just to list a couple other companies that he owns that would probably be of interest to our listeners. He owns MCO, Verizon, UBS, Chevron, and BNY, Bank of New York Mellon. Those are big plays for him. He also is wholly owns BNSF Railroad, which is Burlington Northern Santa Fe. That's a big provider of the oil.
Yeah, and he's made some major buys into Oxy lately, which is Occidental Petroleum, another energy company. That's been kind of his latest headline buys, where he's taken some pretty significant positions there lately.
Yeah, and then to wrap that up with the insurance side, I think is interesting. He owns Geico, General Reinsurance, and Berkshire Hathaway Reinsurance, National Fire and Marine Insurance, and National Indemnity Company. Insurance companies are, huge cash flow opportunities for a lot of people. So a lot of big firms and pension programs are heavy in insurance ownership. So that's pretty interesting. I find the stuff on Buffett to be timely when they are provided, because you look at where Chevron's gone and how high they've risen and where oil's gone. I mean, I think we all know oil is a foundation to almost everything that we have, including the microphones we're speaking into and the solar panels that we're talking about making and the cars we drive. I mean, it is the essential component to almost everything at the end of the day. And
then some of these things are going to play back into the conversation around this lost decade notion, and where do you put your money when you think that the kind of passive index play might not be in your favor, and energy is a big part of that story.
Yeah, agreed. Well, to wrap it up with our Money in the News, our last article here, which we thought it just kind of popped to the top, just considering some of the notions of what's going on. But the article's from Sarah O'Brien. Assisted living communities average more than $4,000 a month. This is where they are the most and least costly. This comes from CNBC. And I think the thing that drives this article to be extremely interesting. So the assisted living facility ranges between $3,000 and $5,800 a month. So that's about $36,000 a year to about $70,000 a year, which is a big deal. But when you actually start looking at the least and most expensive, I was just shocked that New Hampshire was number 2.
Yeah, the most expensive category. Yeah, that was surprising to me as well. And the top end of the list is comprised of a lot of the New England states, but just generally speaking, New Hampshire is I would consider it to be on the lower end of cost of living in general, and wages and a lot of economic factors. So to see that cost,
to the New England states, like the New Yorks and the Connecticut,
to the Northeast. Yeah.
So I'm just wondering, the disparity of assisted living versus long-term care facilities, because I heard that. And that's not even addressed in this article, but I heard that Connecticut is one of the highest long-term care facilities.
Historically, it has been.
Yeah. So, that's kind of interesting. So if you're kind of in that in-between phase, I mean, we do a lot. I was talking with some people yesterday about various forms of, long-term care coverage and so forth. And I think it's becoming people just call us about this. I mean, I just got a call a couple weeks ago. I heard about you. I'm just looking for some advice on long-term care. And I think what's really interesting is that people don't necessarily take into account that with all the baby boomers retiring and that 80 million Americans still remain to retire roughly in this country, so over 100 million Americans retiring, I don't know that there's enough beds available between assisted and nursing homes to provide care for people. I mean, I think that's one of the, we've chatted about different ways to mitigate that and ideas and investment. Just thinking about one thing particularly we talked about, inside joke a little bit, but really there is a care dilemma of provision in 20 years, potentially.
The housing, the nursing, the staffing in general, the whole thing is, it's about to experience a major boom from the demand side. There's no doubt about that.
And I think that's what's really interesting about that is that people don't want to necessarily go to assisted living or a nursing facility. Like, that's not their first dream. I mean, the idea of someone pampering me at some facility sounds actually great right now, but I'm not getting that. So, but in the reality of the sense, at home care is really where I think. I mean, that's you already have your bed there. They can rotate nurses between multiple places, so we're going to see an increase in traveling medical and less people going to a facility just because of the lack of care abilities. So
I think it's people's preferences. You'd hold on home as long as you can, right? Be surrounded by family and loved ones and in an environment you're familiar with. I mean, you would think that's what you want until you reach the point where that's no longer feasible from a medical point of view.
Right. I think it's going to be medically qualified to get into one of these places, like based on how high your medical need of care is. And I think that's right. People want that. I think people are looking for that. And give us a call if it's a question for you, because at-home care is a lot cheaper. It's a lot easier to prepare for. It's easier to financially deal with and address. And I think you can pretty much cover most of the concerns of outliving your wealth if it's done right and planned through. So
we have a particular solution that we go to often. It's not a fit for everybody, perhaps, but if this is a concern of yours or related to a loved one, give us a call, because we think we've got a pretty good fix there.
Sounds good. All right. Well, that's going to do it for us with Money in the News. We're going to be right back with the lost decade and the fears people have around that. And I'm excited about this show. You can reach us at 855-226-8551. Again, that's 855-226-8551. Or you can email us at info@yourmoneyontap.com. That's info@yourmoneyontap.com. Don't go anywhere. We're going to be right back.
Folks, it is so much fun for us to bring you Money on Tap. My name's Seth Kressman. and I am one of the hosts here at Money on Tap. I'm also a financial planner. That's what we do. That's what Ben and I do. And the fun part is we get to have this radio show. We talk about important things that we think you need to listen to and be aware of to help raise the bar as far as your financial literacy. It's a big part of what we're trying to do here. The other thing that we're doing here as well, as financial planners, we are welcoming you to come and call us and to join us at Brayshaw Financial Group. Experience what complete wealth management looks like. Let's take a look at all sides of the issue, get a three-dimensional perspective, and put a plan around your next step. It's so critical, and so many people just leave this part out, and then they find out later, oh, if I only would have known. Hey, don't let that be your story. Give us a call at 855-226-8551 or info@yourmoneyontap.com. If you have $250,000 of investable assets today, our plan is free to you. We think it's important for you to know the facts and have a playbook so you can have a successful retirement. Give us a call at 855-226-8551. Thanks for listening.
Now back to Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Today, we're talking about the lost decade. You know, I joked around with Dan earlier about, the lost years in our life in the early portion of our starting days of college. But in reality, there are parts of the investing world that we wish we could get back. We wish we knew that we should have invested in, that indice or bought this investment, or heck, I really wish I took that guy's stock advice one day, and heard it went up really well. And there's a lot of that, right, Dan? I mean, we struggle through that. It's a problem that people have trying to diversify and balance risk. We know there are investments that are not geared to make huge returns, and we know there's places where we're really betting that we're going to do well long term.
I mean, hindsight's always 20/20, right? So we know this, and even the best out there, at times miss an opportunity that, when you look back at it, was like staring you right in the face the whole time. And I think we even mentioned Money in the News, how Warren Buffett's been a holder of Heinz for forever and has yet to make $1 on it, and he's the best in the business, the best that's ever done it. So, those things affect us all. And, no matter what kind of investor you are, whether it's real estate, it's in the market, those things kind of come and go in front of us all. And sometimes we hit them, sometimes we miss them. But the best thing that you can do is have a balanced perspective and, have a plan to what you intend to do for an investment and stick to it.
Yeah, the biggest problem I think that people don't necessarily, or people aren't prepared for, especially the average kind of guy who's managing their own money or woman, that's just going by historical advice that may or may not work moving forward. Right? There's just kind of this this is what everyone else did, and I guess that's how I'm going to diversify my portfolio, and that's going to work. I think that's a question of, do you believe that there's a demographic change in our country and how people are investing is going to either move forward the same way, or are they going to change based on their goals, needs, and desires for the future? This show is going to be really important for every listener, because the interesting part about the lost decade and what we're going to get into here is what the history of it is, but that some of the largest greatest respected financial minds in our country are throwing up warning signs, buyer beware. And I think, when that happens, even I take notice. I stop and say, hey, I gotta give this guy a read. I gotta understand why he's saying what he's saying. I want to make sure I'm not missing something. So I would encourage the people who are, not sure if you want to hear about a lost decade, but this could be the thing that launches you to the next level, or this could be the thing that you end up struggling through for the next 10 years?
I think what happens is people look at a set of indicators, right, and they say, well, the last time this was happening, these 3 or 4 conditions, what followed that? And there's kind of a knee-jerk reaction to say, well, if it happened last time, it'll happen again this time. But the truth of it is that just because there's 3 or 4 indicators in common, that's not the totality of the situation, right? There's other things at play that could make the outcome different.
So, Dan, what's the lost decade? Tell us.
So, the terminology comes actually out of Japan, which through the 90s and well into the 2000s, for them it ended up being almost 2 decades. Their major market indexes were just flat.
Yeah.
Other conditions, though, ongoing there was 0% interest rates for almost that entire period of time, too. So that's different from what we'll face.
They actually debated doing negative interest rates.
They did. I think they had that for a while, as a matter of fact. But for here, more locally, what matters to us, more importantly, is that kind of following the tech boom and bust of 1999 all the way through the housing implosion in 2008, the S&P itself was essentially flat, which is very, very rare for any 10-year period of time for the S&P to begin and end in the same neighborhood. In fact, there's only one other decade where that happened, and it was back in the 1920s, and it's never happened over a 20-year period of time, what Japan faced. So how much is common to that experience and those conditions from 99 versus where we're at today? That's debatable, and we'll kind of dive into that. But as well, the more important point is that there was still opportunity there even through that period of time.
So I think it's important that, people talk about, what is the market average? We average, 8% or 10% or whatever number or indice you're comparing. And you're really trying to figure out how does that, play into my portfolio? How do I prepare moving forward? Since 2000, a passive investor with a 60% stock, based portfolio, equity exposure, as we call it, and a 40% bond portfolio, experienced an inflation-adjusted return of around 7.5% annually, according to Morningstar. Not a bad return. I mean, if you're just a guy out there saying,
sure.
I don't want to pay, I want to pay somebody 1 or 2% to manage my money, and I'm happy with 7.5%. Hey, that's great. But I think it's really interesting that they're really talking about 2 decades. So from 2000 to now, we're okay. But from December 31st, 1999 to 2009, I mean, an actual negative return occurred.
Yeah, negative 2.72%, and if you adjust for dividends, it was 0.95%. So those are gloomy stats, right? So that doesn't get you real excited about being in the market when you hear things like that. But there's certainly a couple of holes in that perspective, and I think that we want to kind of explore that a little bit and help put some minds at ease. And the first, I think, kind of contributing factor there, or the underlying point behind the math, is the presumption in that is that you bought at the beginning of the decade and you just held throughout the entire time, and you were entirely in the S&P 500. That would have been your experience. However, that's certainly not what we do here, and most investors, I think, have at least some diversification going on.
It's interesting too, because when you talk about the lost decade, you're talking about a time period that started right after the tech boom, right before 9/11. You're talking about, we had some pretty big catastrophes that played into that.
Yeah.
I mean, there's mitigating factors here that are causing lots of stuff. I mean, but I think, you're right, Dan. I mean, you are talking about, hey, here's a stagnant investment. I didn't do anything. I put this money in, and 10 years later I happened to open up the container and found out that I didn't make any money. Matter of fact, I lost money. That's horrible. It doesn't take into account to adding more money to that account. It doesn't take into account, some of the dividends that are potentially available for people and how they might invest in reinvesting those funds. It also doesn't take into account the people who ran out of the market in fear in 2008.
Yeah, I mean, being flat, it sounds like a horrible outcome, but the unfortunate part is for a lot of people, they would have been happy to be flat. One of the things you got to remember about that time too is we're coming through the tech bubble, right, where everybody was quitting their jobs. I remember these days. Everyone was going home and day trading because they couldn't lose. They're literally sitting at the laptop. They could not lose.
Sounds like my son in college talking to his buddies trading stocks on
that's one of the things. That's one of the things that is happening today. Is now you get the day traders back, right? So maybe there's a little forewarning in that notion, but people would just make money left, right, and center buying any tech stock they possibly could. So everyone was a little high on the hog, a little overconfident from where they were at, and those people, contrary to just being flat in the index, they were overexposed and they got hurt. Those are the people I was referring to would be happy with flat. Because they weren't diversified and they weren't, adhering to any kind of professional advice. They just got a little return happy with the roller coaster and maybe stayed on too long.
Yeah, and I think the thing is I still meet people to this day who are still carrying the weight of the 2008 crash, that they sold at the bottom and didn't know when to put their money back in.
Yeah.
That's a really painful. I'm sure we have lots of listeners who are suffering from that. We have people who are trying to figure out, how do I dig out of this hole that I created? And I think, the buy and hold investor only buys and holds as long as that's true, right? So eventually, some point in time, you become an active investor the second you sell.
Right.
And so the person in 2008 is trying to figure out, hey, I sold out. The market's rising. And now what do I do?
Yeah, when to get back in, right?
And so now people are dealing with all sort of competing factors. How do I solve retirement? How do I create income? How do I bring all of this together despite some of these woes that I've experienced in the market? We talk about the lost decade of the S&P, and that is a huge, huge issue. But we've had other lost decades where maybe it wasn't that you lost money, but you basically made nothing. Like commodities for the last 10 years have been doing nothing, right? So it's not just, we're talking about the S&P 500. It's the 505 largest, U.S. company stocks. It's what most people track their investments. I mean, it's funny when people say, hey, the Dow was up today. It's like, well, do you own any of those 30 stocks? Because it might have no bearing.
It's the most narrow of indexes. I mean, it really is.
Right? It's like, hey, can you even name any of them? And it's like, you don't even own one. So what does it matter? It was up. You could have lost money. So it's kind of interesting because, I do look at the Dow and, hey, the Dow's up today. And look at my portfolio. And my portfolio might be down. It might be that I have one stock or two stocks that might be in the actual Dow. Now, so it's really important to understand that various types of asset classes or indices might have better returns than other ones. And it may be that, one class is, one type of allocation strategy is not doing anything but while other ones are, which is why we talk about diversification, why we talk about, having, some of your money here and some of your money there and trying to tier it. But the one thing that a lost decade, and just, here at Blackstone's executive vice chair, Tony James is calling that there's going to be a lost decade. That's somebody to listen to, and with that, how do you invest, Dan?
Yeah, I mean, honestly, it's something I've kind of heard the rumblings, we read so much of this stuff and, I'd heard it consistently out of one perspective, one particular analyst. And when I saw it kind of picking up a little bit of momentum, 3, 4, 5 guys talking about it, then you really dig into it. But as I was going through that process, the first gentleman that I saw speaking to it was this analyst from Stifel named Bannister. And he'd been predicting it in 2018. It was way off. 2019, way off. So it's kind of like this guy's calling card, right? That's his move. He's the panic button guy.
Yeah.
But so I took that with a grain of salt. But you did start to see it in more and more voices and more publications. So it absolutely warranted a little bit of a deeper dive. And after digging through all that, I did feel much better in the fact that looking through articles and the different opportunities that existed in the market besides the S&P 500, that there was absolutely opportunity and money to be made there. There were lots of other asset classes that did perform through that decade. And so for people who suffered with that flat to slightly negative outcome, I got to believe that was really far and few people in between. It really was the buy and hold in the single index, no transactions. I mean, it's the only way you'd have that outcome.
Yeah, and I think, there wasn't a huge disparity even with the people who were just continuing to add money. I mean, there was downturns, but the downturn was sharp and it was quick, right? It was really 2008 because the market was rising pretty dramatically, for a number of years post 9/11. I mean, the market was moving forward and things were happening. And so it was a quick drop. So in reality, what ended up happening was people just, even they were adding money at dollar amounts way above, so even if you were adding money to it over a long period of time, you could potentially even have a greater loss because you would have had a bigger drop versus, so it's interesting as we're kind of digging through all these moving parts that people really need answers on how to address this. And I think what ends up coming about from all of this, and and we're going to talk a little bit about it as we move forward after our break here, but there's a major difference between passive and active investing. When everyone's day trading, passive investing flies. It is easy. You don't have to worry about it and so forth. As soon as turmoil hits, everyone knows they need active investing. And we're going to talk to you about this when we come back, when to pull the trigger on something like that. You're listening to Money on Tap. We're going to be right back. You can reach us at 855-226-8551, or you can email us at info@yourmoneyontap.com. We'll be right back. For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
Now back to Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw. I'm here with Dan Michelon. You can reach us at 855-226-8551. We're talking about the lost decade and the S&P 500 and how between December of 1999 and 2009, you would have actually lost money in the S&P 500 investment for somebody who put their money in there. And we're going through a number of different scenarios where major key components, major companies are calling for a potential forward-moving lost decade in the S&P 500. The idea that you might not have the ability to make the money you're looking for in that passive, form of investing the way maybe you think you will. Let's talk, Dan, a little bit about, how this is coming about. Why are these people calling for this? What are the environmental factors that are driving that?
Yeah, I mean, I think the first one to point to that's a measurable is, the interest rate world, right? Interest rates are starting to tick up, and there's a presumption there that, and a well-grounded presumption that there'll be downward pressure on profits inside of corporations, right? The cost of doing business, the cost of money, the ability to reinvest in themselves is going to be negatively impacted by the higher cost of money. So there's a real concrete corollary between those times and the bottom line for a corporation, for sure.
Yeah, I think to kind of explain that to our listeners, higher cost of money. I think that's an interesting point. When we borrow money from a bank and we for our house, most of us get a 30-year mortgage. So the cost of borrowing that money is the same. It's flat. It's the same mortgage payment for the next 30 years, right? And so that for us, that's no big deal. We can address the cost. Banks know that we can handle that. We've been vetted financially. But for companies and corporations, some of their notes are only 2, 3, 5 years long, and then they adjust for inflation. They adjust for the rates. They adjust for all the different components financially that banks lend money out. And they're constantly changing their debt. They're either borrowing more or paying some off, but the rates are changing. And the Fed, as they raise these rates, it impacts the rates at the bank, and the bank lends money out at higher rates. So the companies are paying more and more interest on these loans that they have out. And during low interest rate environments, these companies take on massive loans that they're paying really low interest. But all of a sudden, as those rates go up, for them to service those loans, they got to start paying more and more money back, separate from the principal, just to keep it about. And that eats away at all the revenue that they're making. And I think, people don't necessarily understand how that's going to impact them. The profits of the company go down. They potentially lower their dividends. There's all sorts of things that drive the assets down and reduce growth that we've seen coming out of a pandemic.
Yeah, they'll hire less, and the theory would be that innovation will be, more refined, more restricted, because they just have less money for research and development and other growth opportunities in the market. And I think that's a factor that we've talked about interest rates a lot, so we know that's coming.
Hopefully that will affect the next Wuhan lab.
Yeah, well, hopefully that's the case. Well, they won't be able to fly over here at the cost of gas, so maybe it'll just stay there. But I think part of this lost decade fear factor and how it's become a kind of a catchy phrase is less concrete, and it's simply because we're coming off of such a tremendous bull market, right? The markets have been rising for a very unique, sustained period of time. I mean,
you think about it, it's like 10 years it's been raging. For the 10 years prior to it, it wasn't. Right? So
there's it's kind of a simplistic reaction to say, oh, well, it must flatten out or it must go down just because it's been going up.
Yeah, for the last 20 years, you're averaging 7.5% on this article on a passive investor. And at the end of the day, in reality, you didn't make any money in the first decade. So what did you really make in the second decade?
Yeah, no, it even says, it's 13% average in the last 10. So, that all of those returns have been in the last 10 years. So it's kind of predictable and easy to say if you're an analyst that, well, it's going to be less fruitful for the next 10. But I'm not so sure that there's a whole ton of science behind that.
Yeah, it's tough. It's tough. And I think what we need to do is really talk about the fact that, just because there's a lost decade in front of us potentially, it doesn't mean that all the investments will be lost.
Yeah.
Right.
So even through that decade, not every stock was flat. Not every index was flat. Not every opportunity produced a zero return.
Exactly. So, when looking at the returns and adjusting for dividends and so forth, what ends up happening in the S&P 500, a reinvested dividend solution, you still ended up losing an annualized total return of almost 1% a year. So you put your money in the S&P 500, you reinvest the dividends, and your winner is that you lost 1% every year. It could have done better at the bank. Hard to believe. But then you start moving to the S&P 400, which is the mid-cap index. And that's pretty interesting because we have a nice little rise there to an average annualized total return of 6.36%.
Yeah, that's pretty consistent with the history of the market. I mean, that's not a bad return.
And then you jump into the small cap, the S&P 600, the small cap index, which is just all the domestic small cap companies. And that did 6.35, 0.1% difference. And we cite these. This is coming right out of Forbes, but that's a significant parallel. I mean, like here you get the small and mid cap companies roaring through all of that time period, and yet your large cap S&P 500 is just tanking constantly.
Yeah, and those weren't the only opportunities. The emerging market index returned nearly 10% on average over that period. And the bond, the fixed income index was just over 6.5%. So again, while the S&P was flat, there were opportunities and there was money to be made. So, this is where that active management and having the whole perspective of the market as a whole is really critical during these times of flat to negative performance.
Yeah, no, and that's a really good point. And that's something that I think for our listeners, it's really hard to quantify personally when the right time is, because it's like, I don't want to pay somebody nothing. I don't want to pay somebody a bunch of money to go manage my money and do no more than I would do. Right. And at that point in time, you don't need to pay for passive management. There's plenty of companies out there that will take your money, charge you much less than any other financial planner out there who's, providing personalized service. So when you pay for a service, you're paying for something, and it needs to be something you can articulate financially through your life. There's got to be a reason to actually provide that. And I think when you're looking at an environment where we're facing some real headwinds, I mean, when we were talking about even doing this show, the market was pulling back 5-10%, right? Now the market's had a pretty significant recovery, and
the correction's over.
Correction's over, and Russia's saying maybe they won't do anything anymore. We'll see what happens, and so forth, and that will only send us back to another event. But that doesn't mean there's not money to be made somewhere, somehow, with some allocation.
Yeah, and that's where the notion goes back to diversification amongst all these key indexes, and then kind of picking and choosing wisely, the right ETF or the right sector to be in for a period of that time. So not everything is this passive buy and hold. You want to be opportunistic and get in and out of things that you think might work for a period of time, whether that's 6 months or a year or two. Have you finger on the trigger and be prepared to make a move if it's something that you feel convicted about, or hire professionals who have the oversight and the ability to kind of scan the entire marketplace and actively manage those assets for you.
Yeah, and I think that's one of the things where, the diversification, if you are still going to, trot ahead and, I'm going to do this myself, that's where diversification is really going to play in. It's interesting. We had a number of conversations with various clients over the last, few weeks, and some of it has been, hey, why are you doing this, or why did you do that, or what do you think about an investment here, and why do we do certain things that we do in our portfolio? Well, we're taking profits, or we're reallocating for a specific opportunity, or we see an opening somewhere where we're happy with what we made, when we made it, how we invested it. That's kind of the piece, but that story is constantly changing. I think, looking at kind of this, early 2000s, first 10 years of the decade, of the millennial, you're talking about, Barclays Capital Aggregate Bond Index. It's like, 6.33%. Holy smokes, that's a ton of return. You can't get that right now.
No, certainly not in bonds.
So you're not going to, just because it says this is how they could make money back then doesn't mean that that's going to be the moving forward piece. You probably couldn't even do that in a good junk bond portfolio. Yeah.
One of the key pieces here of where there was performance during this last decade, right, was the small cap, and we literally just had this conversation, saying, well, if you use old indicators to predict future performance, and you assume what happened then will happen now, you'd make that run into small cap. But as we speak to people all the time, just factoring in the baby boomers and their appetite for investments and where they want to move their money and the impact that it has on a market overall, that may not be the move this time. Yeah,
over the next 20 years, you're going to have 120 million of our 320 million people retired. They have the majority of the money, and I don't think they're chasing down the next great little small cap company that came out with the next best idea on some tech play.
Right.
I just don't think that's part of the appetite. It's not that they don't probably agree that's interesting or, that sounds great, but truth be told, I think they're saying to themselves, well, what happens if that doesn't work out? I don't want to lose this money. I got to keep every penny.
These same people in the early 2000s were still looking for growth.
Yeah.
This time around, they're going to be looking for income.
Yeah.
So their money's going to go to a different place.
And I think that's the hardest thing for people to contextualize in a real investment world, is understanding that every piece of architected financial planning diversification is based off of the last 40 years, how the baby boomers have made their money. The problem is no one's, forward projecting how they're going to make their money moving forward. It's kind of like the baby boomers are no longer buying minivans. Right? I mean, they're basically done.
Pickup trucks now.
Yeah, they're buying pickup trucks and sports cars. Their desires moving forward have totally changed. Their needs have totally changed. Their investing decisions are going to be totally different.
Yeah, so the notion that because it happened before, it'll happen again, isn't always the fix. So, be nimble, be driven to find success, and make as good decisions as you can, but consider the whole marketplace when you do that.
You're listening to Money on Tap. You can reach us at 855-226-8551, or you can email us at info@yourmoneyontap.com. We are finishing up the lost decade, If you've got questions, you can reach us at 855-226-8551. We'd love to talk to you. We'd love to sit down with you, see if we can be of help. You can email us as well at info@yourmoneyontap.com because it's about your money. And that's what we're here today to talk about what's next and how to invest and things people are doing and considering, things we're doing in portfolios, things we're thinking about. I think, Dan, I was looking at one of the articles as we were reading through different pieces, and I think it's really interesting. An analyst from the investment firm KKR had said that many, many people will have to take more risk to make money over the next decade. It's it's really very interesting because as you think about that, and as we were going through all the different returns and how people have lost money in the early 2000s in the S&P 500, we saw the crash. It was the lost decade. And we talked about how the mid cap and the small cap and people made 6% plus in that same period of time. But then the international emerging markets spiked at like almost close to 10% as an annualized return. Well, those are all higher risk investments. I find that, the correlation clear. Here you got a massive investment firm talking about it. Hey, you're going to have to take more risk to potentially do that. And we talked about the baby boomers and the desire not to take that risk and to produce income. What are your thoughts on that, Dan?
Well, I think one of the key things you just said there, or key words, anyway, was correlation, right? So there are asset classes that are not correlated to the market that can meet potentially some of the baby boomer demands. Specifically, I'm thinking of REITs, right? So your underlying investment's real estate, which has a solid track record of at least retaining its value, and it spins off income, right? So if you need to find a source of income and your tolerance for the market is waned a little bit due to some meager performance, or you simply just looking to take a kind of a slice of the pie and do something a little different with it, that's a non-correlated income-producing upside potential investment.
Yeah, I think that's a really good point. I think one of the other things that came up in our conversation was index annuities. I thought was an interesting conversation because, a lot of people are really just looking for the income. So whether it's an index annuity, a variable annuity, whatever the scenario piece is, if your market performance is not happening, you might need really just to lock in, a pension or a pension that's going to be, a greater pension the longer you're in deferral. So some of those vehicles can accomplish stuff like that. And I think in reality, people are saying, man, if there's going to be a lost decade, how do I make sure that my time in wait, as I'm waiting for my investments to mature and accumulate, in essence, a value that's going to, articulate income to me in retirement, how can I accomplish that even if I don't have a return in the market?
Yeah, that's where those index annuities, I think, would be a tremendous play because, specifically for the purpose of taking an income, they have guaranteed growth factors, right? So the principal investment you make will be 100% protected, typically speaking, right? So even if the market is negative or flat, you won't lose anything at the very least. So you can tell yourself that. And as well, again, if the money is ultimately destined to become an income source for you, you can tack on a guaranteed growth rate that's going to compound every year between the day you get in and the day you begin to draw down. So that's a way where you could, if we were to have a flat market, you could outperform it taking no risk at all.
Yeah, create a lifetime income that gives you what you need potentially. Now, I think there's another direction too that we've chatted with people about, and I do think this is going to be an interesting conversation, is just really, blue chip stocks. We talk a lot about blue chip stocks in our office. We talk about dividends. We talk about yields. I really do think that that's another alternative, kind of uncorrelated to the general perspective, but they are U.S. large caps, right? I mean, that's really what the S&P 500 is. So let's talk a little bit about that. I think for our listeners, the annuity is not always going to be the standard play.
Sure.
And we love the straight up, I love the market. The rest of it's kind of like, it's boring. It's like watching a black and white movie versus watching a color movie. I mean, it's, there's just more entertainment to it. It's exciting. It's moving. It's creative. In the market, there's opportunity to buy and sell. And I think that's really where I see a lot of opportunity in trying to take advantage of growth in various blue chips, take profits, enjoy yields, enjoy dividends while they play, and then look for other opportunities to buy in later on.
Yeah, I mean, somewhere out there will be performing stocks. The question is, can you consistently pick them?
Exactly. which is why we've got you, Dan. No, I'm just kidding. You're listening to Money on Tap. Thanks for being with us today. We appreciate it. And for you, Seth is still in recovery, and so keep him in your prayers. We miss him greatly. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Come visit us back next week. We look forward to talking to you.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.